how to understand stocks. What is a stock? You hear it all the time. Do you know exactly what a stock is? A stock is a piece of a company, um, in the most general terms. Now, if you have a stock in Apple, for example, um, if you own stock in Apple, do you own a piece of this iPhone? No. The piece of what you own is a piece of their cash flow. Isn't that exciting when you read these headlines? The Apple made all this money. Now, that's oversimplifying it, but if you want to know, basically you own a piece of their cash flow. Really, you own a piece of their full financial, statement, um, and the value that the stock market places on their financial condition and growth prospects. So if everybody thinks Apple is going to go up, then the stock, as long as more people think Apple will increase in value, more people think then they think it will decrease in value, then it'll keep going up. Basically, if it's more popular, and usually you want to make sure that the financial performance is there. A lot of times, you know, a stock is usually popular because it is doing well. It's either growing very fast or it's very profitable. Now, a lot of times, now sometimes it's hype though. Tesla, for example, Tesla's growing very fast, but it has a lot of debt and it spends money very quickly. So there's a limit there. So I'm adding that nuance to my initial statement. Don't just buy a stock because it's popular, because you see that's only temporary growth, stock growth off of popularity. You want to buy a stock because it has sound financial statements and a sound financial condition, which the financial statements are supposed to be a reflection of financial condition. You want to buy a stock because, for example, it has increasing cash flows, decreasing debt as compared to its income that it gets to keep, called equity. Those things. You want to buy a stock because it is improving its financial performance. It's very hard for a non-professional to understand all that. So what they have a simple solution, and it's called a mutual fund, which has a professional that analyzes all these stocks. It has a team that analyzes all these stocks and says, hey, this is EB's mutual fund. Do you believe that EB is a good, stock analyzer and stock picker? And you say, based on EB's past 10 years and performance, he's been doing really well. He's been getting a good return, and he's been beating the market average. Then you can say, okay, I don't understand stock enough to analyze it, but EB has a really good track record in his mutual fund. I'm going to put my money in EB's mutual fund. That's how most people invest in stocks, because individual stocks, the Apples of the world, we could find out that Apple's phones cause cancer or something crazy like that, and then their stock will drop like a rock, and your interest, the stock that you own, the piece of their financial value, and their financial condition will shrink. So if you put $100 in there and it shrinks 50%, Apple does, then your $100 shrinks to $50. So that's why stocks are very risky. You're buying a piece of the financial performance and financial condition of the company, as valued by, meaning in the opinion of the stock market. that it's on. So similar to concert tickets in a way. What do you mean? Why do you pay this much for this concert? $500 or something for Beyonce tickets close by the stage. Obviously, I've never been to a Beyonce concert. It probably costs more than that. But anyway, and then a lower artist has, you can buy their tickets for $20 or something like that. Well, it's based on the market. All of the people want to buy and sell Beyonce tickets. And if they know that if they sold that, then there's definitely a person there to buy it at that price. Similar to stocks. Your share of Apple is, maybe around $150 now. I haven't looked at it in a while because the market has a buyer for every seller who wants to sell at $150 at that specific point. So it's a complex thing. It's not something that I can break down to you, but the value of your stock in the most simplest terms is based on how other people in the market, how they value it, and the true value, which is called the intrinsic value of the stock, is based on the overall financial condition of the company, broken up into small pieces called shares of stock, and you can buy it. So and you hope that little piece that you bought becomes more valuable because the company performs better and improves its financial condition. So as you can see, it's not a very simple thing. You want to, which company do you know for sure is going to get better and their financial condition is going to get better? You just don't know. You're pretty confident in some companies like Amazon, just an example, not a stock tip, but that's how people invest. That's why you say it's kind of like calculated gambling with more data, more sophistication to it, but it's a gamble. So you want someone to help you sort through all that, someone to help you break it down step by step and apply it to your specific situation in a way that makes you comfortable and in a way that fits with the rest of how your financials, the condition of your own personal financials. Do you have a lot of savings? Can you afford to take more risk because you're younger? Those type of things. Then you can approach me, contact me, and we can discuss for free. And then if we choose to go forward, we will work out something fair. All right. Have a great day. Thank you. Bye.